Artificial intelligence, investing, and why guessing is expensive. Quick question. If investing were just about intelligence, why do smart people still buy the top and sell the bottom? Today we're talking about AI and investing, not the hype version, not the sci-fi version, but how data-driven investors are actually using AI to make better decisions. First, the human problem, and I mean no offense. Let's start with an uncomfortable truth. Humans are emotional investors. We chase what's already up, we panic when the screen turns red, and we confuse confidence with a process. According to analysis by Dalbar, the average retail investor has underperformed the S&P 500 by roughly 5 to 7% per year over the last 2 decades, not because markets are rigged, it's because emotions don't scale well in volatile environments. Fear, greed, and group chats are not an investment strategy. So why do institutions lean on AI? This is where AI quietly enters the picture. AI doesn't panic, it doesn't guess, it doesn't scroll Twitter at midnight and change its thesis. Firms like BlackRock and JP Morgan run machine learning models across earnings, data, macro trends, valuation shifts, institutional flows. We're talking millions of data points, updated continuously. McKinsey estimates AI-driven systems can improve forecasting accuracy by 20 to 50%. Not magic, just math applied consistently. So here's what artificial intelligence actually does and doesn't do. Artificial intelligence does not predict the future. What it does is narrow uncertainty. It answers questions like, is this stock statistically cheap or expensive right now? Are earnings expectations improving or deteriorating? Is institutional money accumulating or exiting instead of asking, how do I feel about this stock? Artificial intelligence asks, what does the data say? And how often has this setup worked before? That shift alone changes outcomes. Here's the part most people miss. AI isn't useful if it lives in a research paper. It's useful when it's structured into clear, repeatable signals. That's why systematic approaches now make up roughly 60 to 70% of US equity trading volume. Not because machines are smarter than humans, but because systems are more disciplined. Some platforms now combine valuation models, earnings, probability analysis, institutional flow tracking all in one place. So decisions aren't made in isolation. The goal isn't perfection, it's reducing costly mistakes. So here's the real takeaway. The edge in modern markets isn't prediction, it's process. Investors who rely on opinions will always feel busy. Investors who rely on data will feel boring and quietly consistent. Tools like Truthsayer AI exist for one simple reason: to help investors think more like institutions without the emotion, guesswork, or noise. Because markets don't reward conviction, they reward repeatable decision making. And if your portfolio still depends on vibes, there's probably a better way to do this. Want to know how we trade this major technology trend? At Truthsayer AI, we trade every single one of the alerts our AI generates. If you are interested, you can join the thousands of clients already on our app who are taking advantage of these trades every day. Remember, we trade every one of our alerts our machine learning and AI models generate. Sign up on our website. You won't regret it. Thank you for watching, and don't forget to like and subscribe.